The UK's investment and management industry is an important subsector of the UK's world-leading financial services industry. Asset managers and investors benefit from the comprehensive ecosystem that underpins this status. This includes an open business environment, a skilled and diverse workforce, a transparent legal framework, a beneficial time zone, and the presence of many international firms. The UK's investment management sector has developed into what is now one of the largest global hubs, and it benefits from the fact that the capital markets in the UK are highly liquid and international, with long-standing strengths in facilitating global asset allocation. Meanwhile, in China, its investment management industry is one of the fastest growing globally. This, combined with the acceleration of China's economic reform and market opening up, China's investment management industry is set to play an increasingly important role in the global markets. We are very pleased to have Dr. WANG Qing as our first guest of this series, sharing with us the latest development in China's investment management industry, how Chinese managers, investors are coping with the challenges, and what are the potential growth opportunities in the Chinese market. Dr. Wang is the president and chief economist of Chongyang Investment Management, one of China's top private asset management companies. He has over 21 years of professional experience and has held senior positions at China International Capital Corporation, CICC, Morgan Stanley, and as an economist at the IMF. He is a regular speaker at major forums and international media channels. We're also fortunate to have Shelley Yang with us, who is the founder of Investeo and the former CEO of Haitong Capital, to host the conversation for us. We hope that this series will set out the opportunities for further growth in the months and years ahead as the economic environment continues to change at pace, world markets evolve, and society recovers from the COVID pandemic. Now, without further ado, I now pass over to Shelley and Dr. Wang. Thank you.
Thank you, Lord Mayor, for providing this opportunity. I'm delighted to conduct this interview with Dr. WANG Qing to kick off the first session of Meet the Leader for City of London and Investment Management Association. Thank you very much. For those who doesn't know Chongyang that much, Chongyang is a Shanghai headquartered, independent, active asset manager, a China equity specialist with a value or contrarian value style manager for almost 20 years. So they see the different cycles in the Chinese market with ups and downs and with the development in different cycle. So today we prepare a few questions because China, starting with this coronavirus earlier than the rest of the world, they already finished the first cycle of this public health outbreak of the pandemic, and then the economic turbulence, and now a little bit political rhetoric. So I think with everybody is locked at home, and Dr. Wang already working in his office from the similar version of City of London in Shanghai in Lujiazui. So he will give us a better view about what happened and what will happen, what is the opportunity, and what we can working on in the future. I will prepare some slides. So for Dr. WANG Qing to give some thoughts because he sees through different cycles from a different perspective, Western and Eastern. So that will be a very good expert to give us a first-hand view about everything. For Investeo, we are UK-based China specialists. We select very few asset managers with consistent outperformance history, solid governance structure, and risk management practices. So with that, let me show my screen to have a slides to start the conversation. So my very first question is to Dr. Wang. What do you see how this incident outbreak in the early days of 2020? What do you see the Chinese markets doing, and what's different with the global leaders? Everybody's print out stimulus packages, and what China do is different. Thank you.
Okay, thank you, Shirley, and thank you, Lord Mayor. It's my privilege to join this discussion, and I'm honored to answer the question from Shirley. What has China done in this? How Chinese market performed since the pandemic? I prepared this slide. It's quite clear that Chinese markets, I mean here primarily the equity markets, suffered drawdown just like other markets. But at the same time, you can tell that Chinese market dropped relatively less compared to other markets. That suggests that Chinese market shows quite some remarkable resilience during this global pandemic. And when we talk about Chinese market, they tend to include both onshore market, that's Chinese Asia market, and primarily offshore market, that's Hong Kong H shares. And Hong Kong H shares did relatively better than other markets, but underperformed Chinese A shares. This primarily due to that Hong Kong market is a typical offshore market that it has subject to the liquidity crisis that took place in March that have most impact on the rest of global markets, while Chinese onshore market was somewhat less affected. Shirley?
So this is that's a general output and the performance of the overall market. But with the damage done by the lockdown, the slowdown of the economy, and we see even in the past few days, we didn't show the indication of the growth. So what is your projection of the outlook of the rest parts of this year, and also what is the projection of outlook for next year?
Okay, yeah, in fact, the reason Chinese markets seem have done relatively better than other markets, I think has at least two reasons. One is that related to the economic fundamentals, and in this regard, there is this pattern of first in and first out. The pandemic broke out first in China, and Chinese government took early actions. In fact, took quite draconian measures to lock down the country for almost 2 months, and the economic activity came to a standstill for 2 months due to this, dramatic and to some extent efficient measures. And the pandemic has been largely under control by now, and the Chinese economic activities start to recover. In fact, if you look at the chart on the left on the slide, it indicates the level of activities of key activity or key sectors. It suggests that the recovery is well underway. I think that's the one of the key reasons why Chinese market did relatively better than other markets. So that related to the economic and corporate fundamentals. And another reason being that related to the initial conditions of Chinese market compared to other markets. For instance, if you look at the valuation of Chinese market, compare that with the valuation of, say, the US market, in Chinese market are more reasonably valued and than that of U.S. market. Put differently, there is a large margin of safety in terms of valuation. Therefore, when the markets are subject to the same massive exogenous shock like the COVID-19, and the Chinese market shows more resilience. I think that's how I understand the performance of Chinese market. But looking ahead for the outlook for the rest of the year and into next year, we remain constructive. First, again, related to the economic fundamentals, we expect Chinese activity, economic activity, will demonstrate kind of V-shaped recovery, especially domestic demand, and in part reflect the very strong policy support and policy stimulus that implemented by Chinese authorities. And the second one being that China's credit cycle, which is critical in influencing the economy and the capital markets. The Chinese credit cycle, in fact, turned expansionary in the wake of this COVID-19 pandemic, and after nearly 3 years contraction. This is key. In another word, a Chinese credit cycle term expansionary and kind of triggered by this special shock. That's reason number two. And third one has to do that after all, Chinese economy is still considered a developing country, developing economy, and there are still several structural driver growth at work that ensure that even look beyond near term, the Chinese economy should still be able to maintain a decent level of growth. And with those structural driver for growth, including, for instance, the most important one is urbanization and digitalization, as well as further opening up in many sectors, especially the financial sectors. So we have in the near term, V-shaped recovery in the domestic demand and turn around of credit cycle, and over medium long term, structural drivers of growth remain intact. That's why we, at the current juncture, we remain quite constructive on the outlook of Chinese markets.
So there is two good drivers for Chinese recovery. One is the major cycle. It's first in, first out, and also the second one is the fundamental of its growth cycle based on the Chinese economy. It's still very young. However, it is very China is a global manufacturing hub. So it's the supply chain all concentrated in China. With this lockdown, people are rationally thinking about the reshoring, the restructuring of supply chain. Do you think that will realize? And if it realizes, will it damage the Chinese economy? And who will be the beneficiary? And what will happen?
Well, it's a good question. I think the issue of reshoring of the global supply chain has indeed become quite a topical and popular of late. Of course, if we realize it will have a major negative impact on Chinese economy, because after all, China is the largest manufacturing country and is the hub of manufacturing activities in the global economy. Having said that, it seemed to me that the issue of reshoring of global supply chain reflect more of fear than fact. And if any, there may be going on some disruption of supply chain, but that perhaps has more to do with the impact of COVID-19 outbreak instead of some sort of strategic rethinking, relocation, even reconfiguration of the global supply chain. So I think I kind of understand that the concern of many on the potential outlook for reshoring of the global supply chain, but as far as us as an investor is concerned, we consider this is a risk factor that we need to be really mindful of, but we do not treat it as a risk event that warrants immediate action, because we need to disentangle what's the short run impact and the long run implication. The short run, there are some negative impact on the supply chain, but does it have to do with reshoring of global supply chain out of some bigger concerns, or is this simply in the short run because the COVID-19 pandemic? So we are mindful of this risk, but we keep a close eye on it. And I think even if this reshoring of global supply chain were to realize, it will take time in our view, because if you were to relocate or reconfigure the global supply chain, at least you need to put upfront capital expenditure. You need to spend money, and you need to invest a lot of money to try to realize that. And at the current juncture, I believe many corporate are under some financial difficulty, and it's difficult to conceive that they would allocate a large amount of a budget for capex to realize this reshoring of global supply chain. So if any impact, any consequence of this, then it will take time to show. So that's why at the current juncture, we pay attention to any development on this front, but we are not yet taking action as far as investment decision is concerned. And so this is something that our mind beyond near term. But in the near term, in the quarters immediate ahead of us, we see more opportunities than risks. For instance, if you look at the slide present on the screen, and we think if we are going to take a top-down view for the next 6 to 12 months, I expect, at least in Chinese equity space, the cyclical sectors should stand to benefit from a V-shaped recovery in domestic demand. And if you look at the chart showed on the screen, and it's those cyclical sectors that suffered a loss most, because most investors are still quite preoccupied with the short-term negative impact of the lockdown, and they have yet to start to pay attention or appreciate the potential strong recovery in economic activity, at least those related to domestic investment and domestic consumption. So we think we should be mindful of risk down the road, but we also need to want to seize potential opportunities in the near term. And we think cyclical sectors should stand to benefit from the V-shaped recovery in the domestic demand. That's where the potential outperformance opportunity lies.
So with the COVID impact, there will be long-term risk factor you need to put in the mind, and also there's a although the risk is not the immediate, it's not transactional, but you still need to develop some strategy. So from Chongyang, what did you do strategically in the medium term wise? What do you think in Chongyang's view strategically and transactionally? What were you getting ready for the opportunity and the risk if the impact happened?
Well, the COVID-19 pandemic and the attended Great lockdown will have a profound and enduring impact on the global economy and on Chinese economy and the capital markets. While we are still debating on the many issues with no strong conviction, we do subscribe the view that in the post-pandemic era or in the post-COVID norm, the overall debt level, especially public debt level, will remain very high for a very long time. Therefore, interest rates will most likely stay low for longer, and the developed countries will continue to live with slow growth or a secular stagnation for some time, and consequently, emerging markets would have to count on their domestic demand for growth. So those are the key features that may in the post-pandemic norm. So it's in this context we think of our investment strategy for China. I think first and foremost is this is the environment where growth will be a scarce commodity, and so we need to be strategic long on growth, and that's for sure. And we need to work very hard to identify potential growth opportunities and growth companies. So that's something we need to work and consider as a strategic take a strategic view. Having said that, I think we also need to look at in the short and medium term the cycles. The cycle being economic cycle and the liquidity cycle. And so if you look at the diagram on the screen, that's the framework we use in trying to come up the strategy, investment strategy that going forward. And we basically study the features of key characteristics of economic cycle and liquidity cycle. And along the horizontal axis, that's the liquidity cycle, and from left to right, liquidity cycle from contractionary to expansionary, and more importantly, along the vertical axis, that's the economic cycle. At current juncture, where we are in a kind of economic contraction phase, and that's the economic cycle. And at the same time, however, we are in an expansional phase of liquidity cycle. So this kind of combination it would suggest that this is the environment that you will see the growth stock and defensive stock tend to outperform. So that's the current environment. That's how we position ourselves to win in this environment. However, if we look ahead and look into the future, and we should expect this kind of strong recovery in economic activities in the coming quarters, and so such that the economic cycle will gradually turn from contraction to expansion. So looking ahead for the next 2, 3, and even quarters, even into next year, we may end up in a different environment. That is economic cycle in the expansion phase, at the same time, liquidity cycle also in expansion phase. In that context, we should look for opportunities in both growth stocks and the cyclical stocks. So that's how we position ourselves, how we formulate our investment strategy. So strategically, we long on growth stocks. At the same time, tactically, we are bullish on cyclicals, especially if some of the cyclical stocks valuation become really attractive. We are willing to take early action at current juncture.
Thank you. It is really hard to tell when you see how you have this strategy, but how to interpret it, because the foreigners, especially Western investors, have difficulty understanding China. So just a few days ago, the head of BNPS management, she's talking about the Chinese market. She understands that market very well, and her comment is China is a very complicated market. In your view, how to interpret it, and any tips for Western investors to understand Chinese companies?
A good question. Well, Chinese market is a very large market by now, so it's too large to ignore. At the same time, as you suggested, indeed, the market is difficult to understand, at least to some of the outside observers. I think you will take a combination of a global perspective and a local knowledge to get a better understanding of Chinese economy and Chinese markets. First, let me just lay out a few special features about Chinese markets. Just give you a sense that how different, how kind of unique Chinese market are compared to other markets. First, that is, if you look at the onshore Chinese equity market, or we call it Asia markets, it's still largely dominated by individual investors. And as shown in this chart, and individual investors or retail investors still account for over 50% of the trading activities, and they hold more than 50% of the free float shares, with the so-called institutional investors account for the rest. But even among those so-called institutional investors, in fact, some institutions, like mutual funds, even private funds, their behavior is not much different from retail investors, because the genuine institutional investor in China is still quite quite rare. And when we talk about institutional investors, typically when we talk, those institutions that own the money. But in China, really institutional investors who really own the money owners are quite few. So this is one key feature of Chinese market. Because of this dominance of retail investors, that suggests that the market efficiency is relatively low. And on the other hand, it also suggests that you have lots of opportunities for more professional and long-term focused investors. So this is one key feature. The other key feature is that Chinese market is in fact quite attractive, at least from the perspective of global asset allocator, because it offers somewhat high returns, at the same time low correlation with other asset classes. If you look at a table on the slide, and the rate of return is quite remarkable. But of course, the high rate of return also comes with high volatility. What's more interesting is that if you look at the correlation of Chinese equity market, especially the onshore Asia markets, the correlation with the rest of global markets are relatively low. So relatively high return, relatively low correlation, that is quite good kind of asset, at least for global investors, especially global asset allocator. This is a second important feature of the Chinese market. The third one is that what I call Chinese market can be considered quite a heaven for active management. By now, passive investment, through ETFs become very popular and increasingly dominant force in the mature market. But in Chinese market, data suggests that active management can create lots of value. And if you look at those data on the table in the slide, and in fact, several key indicators like performance, win ratio, and survival probability, and so on, for 3-year period, 5-year, and 10-year, Chinese market stand out. So this is a market where active management still kind of create value. So those are the quite interesting and quite important feature of Chinese market, and it's really in addition, if you also consider the size of the market, it's really a market that one cannot afford to ignore. Having said that, Chinese list universe now having over 5,000 list companies. So in order to explore those opportunities and to really make money in this market, one really need to devote resources and show commitment, and because you need to do a hard research. China has over 5,000 list companies, and 70% is the onshore, in the onshore market, and the rest of offshore market. And of those 30% offshore markets, 20% are listed in Hong Kong. So if for outside investors, especially West investors, if you want to explore opportunities that are discussed in this market, you need to show some commitment, either have a China dedicated research team or work with some China specialist, so that that's how I think Chinese market can really benefit investors from the rest of the world.
Thank you, Dr. Wang. Very agree with you about the market, the active market in China. Because looking at the data, we see the CSI 300, which is the benchmark of Chinese capital market, equity market. On the 5-year or 10-year basis, it will be outperformed by the leading active mutual fund by a very big number of alpha, pretty much like a 10%. And for a leading private funds, very unique private fund management companies, when the top ones compare with the leading mutual funds, it's another extra 3 to 5%. So it's a very good market for alpha-driven asset managers. But given time, when the market grow much institutional and more sophisticated, I think the market still will have time to be put to the mini regression into the developed market, but it will take a long time for us to go. So I agree with you. We need a local guide to help us to find the good opportunity and interpreting with the cultural background, with the understanding of the local regulatory frame to understand the opportunity, domestic Asia and also in the Asian market. My next question is, since this is such a great market and too big to be ignored, for the foreigner, what do you think? Recently, the opening of the capital market and opening of the financial market by the Chinese regulators, what do you think? The new policies were coming out for the investors to participate into the capital market?
Well, Chinese authority have announced a number of quite meaningful policy measures to further open up Chinese financial sector, and since last year, in the context of so-called trade war vis-a-vis the U.S. In fact, China accelerate and speed up its opening up of financial sectors and giving better, wider market access for foreign companies in the broker business, in asset management business, insurance and banking, and so on. It's quite profound, quite a widespread opening up. I think we should, as my advice to potential players, foreign players, is that you should take the effort undertaken by Chinese authority seriously, because this is not just a tactical move in the context of negotiation with the U.S. Rather, it's out of China's own need, because the broader context is that China used to have a very high saving rate and a lot of abundant liquidity, a lot of money available, and therefore the Chinese own market, Chinese own financial system are sufficient and they are able to do the job to convert saving into investment. But after 10-20 years, China, the saving rates start to drop, and the abundant fund is not as abundant as before, and China need more efficient financial intermediation. China need more efficient financial institutions to keep up the saving investment transformation and keep up the economic efficiency and the growth. It's in this context why China start to open up for the financial system. So this is out of Chinese own need. That's why we should take this opening up effort as something long-term commitment, as something serious. Although in China, there's one important meeting taking place in China right now that's called so-called 2 sessions. So far, there haven't been any new concrete measures to further open up our Chinese financial sector. But in the government work report, a Chinese leader did reiterate their commitment to the policy measures they announced since last year. I think the deregulation in this regard will be maintained and even strengthened going forward. And the Chinese market's participation from outside investors still quite low. If you look at the data on the screen, in fact, both the equity market and bond market, the penetration ratio of foreign investors still low, low not only by China's own standard. For instance, the foreign investor shares of Chinese bond market and equity market only account for roughly 3.5% of total market cap. This very low, and this is, in fact, is one of the lowest penetration ratio in the emerging markets. So the room, the potential growth opportunity for strong foreign investors, foreign players in Chinese market is huge. So I think one should seriously consider come to Chinese market because this is where opportunities remain quite abundant.
Yeah, given the Chinese market is expanding, the listing and fundraising activity will continue to grow. But one very concerning fact is the discussion, especially the last few days. The U.S. passed a bill that it's about auditing policy that the foreign companies has to fully in compliance with the auditing procedure for any foreign companies, which most of the U.S. company and other foreign company already did. Obviously, some Chinese firms do not. So, do you think that that will reduce the attractiveness of the U.S. market for a Chinese company to raise money, and which will consequently give opportunity to other markets, like Hong Kong, London, or other markets? What's your thought on that? And also, we have seen some Chinese companies have some really bad practice on the market. What do you think these two factors combined together will have what kind of implication for the fundraising activities for the Chinese companies?
Well, this is very good question, Shirley, and but it's also a difficult question to answer. And I think we need to put this discussion in a broader context of the current really tension between U.S. and China, and the discussion, all sorts of discussion about decoupling between U.S. China and of course, when we talk about decoupling, there are different layers of decoupling. We already got quite a good sense of what's decoupling in trade flows like since 2 years ago when U.S.-China trade war broke out, and but U.S.-China reached a phase 1 trade deal that kind of put a trade decoupling on a pause, and U.S.-China trade relationship was set to a new equilibrium where China paying higher tariffs and the U.S. grant China continued market access. But this is trade decoupling. What you just suggested that in fact create fears or general fears among many that next we're probably going to see a financial decoupling, and this indeed the potential prospect of this is really disturbing, because supposedly the financial decoupling is more of a concept rather close reality, because after all, U.S. is quite strong as far as financial market are concerned, and so it's unlike the trade, especially trade in manufactured goods, where U.S. is not as strong as China. So when it come to financial markets, U.S. should be quite comfortable with the status quo, but if there were to be a financial decoupling, of course, it will have a much wider impact. In addition to the issue we just mentioned, that allow Chinese company to be listed in U.S. Stock markets. But of course, it's in this context, there is a case of fraud by this particular company, and I think it's really I would consider this particular company, this Luckin Coffee company, as an isolated case, because it's a fraud, it's crime, and it's shameful. And so for anyone who dare to commit this crime will face penalty, and we will be punished under the rule of law. I think for a large majority of Chinese companies, either listed in China or offshores, they are just listed companies like many other listed companies in other markets. What really I'm concerned is the prospect of financial decoupling, broader financial decoupling between U.S. China. I don't think it makes sense, but a lot of insensible things now, nonsensible things now happening. If we're going to really look into this, I think if the tension between U.S. China were to escalate, I really do think there is an opportunity for China to tap other major markets outside the U.S., including the market in Europe, especially London markets. For instance, I hope it's just a coincidence that China recently approved another major company to do GDRs in London market. That at least that's a if it's not coincidence, that's an indication that China start to explore alternative global market financial center as a potential hedge to the U.S.-China financial decoupling.
I agree with you. The isolated case cannot be grouped into something like we had Enron scandal a long time ago. It doesn't impact the overall the groups. I think the most company they are practice in a better way, try to bring better life to the people. So I think there's isolated cases and the generalizing of the issue, and also I believe diversify fundraising activity globally in Europe and in London and in other markets. I think it will come given the size of economy. So I'm really happy that I go through my question list, but I see lots of questions from the audience. Let me go for a short session that let's discuss. Let me take a look about what is on the panel. Yeah, there's a discussion about the U.S.-China relation. I think we already touched on that a little bit, and about the future of the Chinese domestic economy as the decoupling. Yes, that question. And also another question is about the recent article about Ray Dalio. He published a book or an article conducting a research going back 500 years for emperor currency. There's a reserve currency as an emperor. So they compare the Dutch, the Great Britain, and then United States. In his article, he's mentioned that China could be the rising emperor, although 500 years ago, Chinese emperor is leading the East and the Spain leading the West. So in his view, he's thinking about maybe China will be the next emperor or reserve currency. What do you think about it?
Well, I read Mr. Daniel's book and his articles on those very interesting issues. In fact, I really like Mr. Daniel's research and his insights. Is very, very interesting, very stimulating. I hope Ms. Ray's views will play out over time, but it's really a very long-term view. And if someday Chinese currency or Chinese renminbi become a reserve currency, I think that will take a long time to materialize. Because after all, for currency to become reserve currency, there's lots of institution arrangement and infrastructure investment. By infrastructure, I mean not only the hard infrastructure like the payment system, and also the soft infrastructures, the modern institutions, independent central bank, and well-regulated, transparent financial banking system, and capital transactions free of restrictions, and so on and so forth. So we as a Chinese, I certainly hope someday China can achieve the status as described by Mr. Ray in his article. But as a practitioner, I also realize there are lots of work to be done before China can achieve that kind of status. And in the near term, I expect China further open up its financial system, and as a step, eventually pave way for capital account liberalization. And the capital account liberalization is one of the very important precondition for a free float of Chinese yuan, and for it to eventually become a global reserve currency. But it will take a long time to achieve.
Thank you. I'm running out of time. I have one more question from the audience. What do you see the next black swan? Is Hong Kong issue will be the black swan? What do you think?
Well, certainly the Hong Kong issue is a potential source of risk. But as a equity market investor, the way we look at Hong Kong is that Hong Kong is a typical offshore market, and by that I mean it's a financial center, but it's typical offshore market in that, for instance, Hong Kong's stock exchange, many of the listcos are in fact companies based in China, based in mainland China. So their activity, their revenue, all taking place in mainland China. It happened to be listed in Hong Kong, and investors in Hong Kong markets also mostly are offshore, and increasing a share of investors also coming from mainland China. So Hong Kong as a typical offshore market, in fact, the fundamentals are not related to what's going on in Hong Kong, not going on in the street of Hong Kong. So at the same time, the liquidity conditions in Hong Kong is actually determined by U.S. Federal Reserve, because under the Hong Kong linked system, Hong Kong dollar is linked to the U.S. dollar under the currency board arrangement. So in fact, Hong Kong's monetary policy and liquidity condition are determined by U.S. Federal Reserve. So it's those unique features related to Hong Kong. I doubt what's going on in Hong Kong right now, or potentially taking place in Hong Kong, will have a lasting, enduring impact on the performance of Hong Kong market, other than the negative impact on some of the local Hong Kong companies. So as an equity investor, I would not dramatize, overemphasize what's going on in Hong Kong right now as a potential risk for investing Hong Kong list shares, especially the H shares. Those are the China-based companies but listed in Hong Kong. I think eventually the performance of those shares are determined by their fundamentals related to Chinese mainland economy and the liquidity conditions determined by U.S. Federal Reserve.
Thank you very much. Very, very clear about the investment perspective. So I think I'm pretty much run out of the time. I will give it back to Lord Mayor. For us, we only have 5 more minutes to go. Thank you.
Very much. Hopefully I'm unmuted now. Thank you very much, Dr. Wang and Shelley. That's been a fascinating discussion, and thank you everyone for joining the webcam. Look forward to seeing you in person. I know that Catherine McGuinness, Chairman of Policy, was due to come to Lujiazui this year, but I'm sure one of us will be there next year, if not before. So thank you, and thank you everyone for joining the call. Thank you.
Thank you.
Thank you, everybody.